Let's focus on a couple of macros that we're expecting later this evening. The IIP as well as CPI numbers will be in focus. Ekta, take us through what the street expecting.
Well, you know, the RBI policy is over, so the relevance of the CPI and IIP data is a little lower, but the street is going to be watching out for the trajectory. For CPI especially, the street will also be watching out for what happens with other triggers such as the monsoon, whether that's going to be normal and what kind of prices we can expect in terms of vegetables, etc. going forward. So for the month of March, what we are expecting for CPI is expected to come in at around 3.97 versus around 3.65% on a month-on-month basis. The range is anywhere between 3.8 to around 4.1%. Now the core CPI data is expected to come in absolutely flat at around 4.8%. Now, it is expected to harden overall month-on-month due to higher food and fuel prices. So, overall food prices should be around 2.3 to 2.5% month-on-month, led by higher vegetable prices, which have risen around 10% month-on-month. However, year-on-year, it's still negative due to a high base. So, this 2.3 to 2.5 that we're expecting on food prices compares to around 2% on a month-on-month basis. Cereals are largely flat month-on-month, up only around 0.24%. Even pulses, there wasn't much in terms of a movement. Now, fuel inflation could rise to over 4 to 4.5% versus around 3.9% on a month-on-month basis. Remember, the reason for fuel increase is again the base. In March 2016, it declined from 4.5 to 3.47% on a month-on-month basis, and hence we can expect that sort of base impact to play out this time. Overall, we also have the IIP data which is coming out. So, for example, for the IIP data, we're not expecting much this time, around 1.8% versus 2.7%. Range is anywhere between 1 to 2%. And one of the key reasons for that is basically the core sector data, which came in at around a 15-month low, which is 38% of the IIP, which came in at around 1%. So, expectations are not that great because of electricity, cement dispatches, etc. this time round for core sector.
All right, Ekta, thanks so much for that. We'll be waiting by for both those two data points later this evening. But let's move on then. And as part of our ongoing special series, Asian Tigers, Udayan Mukherjee caught up with Ayaz Motiwala, Senior Fund Manager at Nivalis Partners. And here is an excerpt of strategies, what a strategy should be to build a mid-cap stock picking portfolio. Let's hear it out.
We look at it on three distinct sort of buckets in which we try and buy stocks. One would be, the conventional high-quality stocks at fairly aggressive valuations. We pay up for it, and we hope that our judgment is correct. Here, we are trying to play a sort of time in our favor because we have long-dated capital. So we are trying to buy 2 years out earnings expectations. So that's one type of approach. The other, at the other end of the spectrum, would be stocks which are smaller in size, are yet to be discovered, and have both the need of time and the need of liquidity. And so we try and fish in those waters as well. And then in the middle is where it gets very interesting, which is another way to basically say we're trying to buy slightly broken companies, colloquially referred as buying turnarounds. But with the sharp focus on quality.
Of these three categories that you just outlined, tests your mettle as a fund manager more. Which of these three would you classify as the riskiest?
I think the middle one clearly, because it's often said, and I've probably heard you saying so often, is turnarounds don't turn around, and so this judgment of problem. And also the judgment on timing when this problem would go away is obviously a very, very tough act.
Have you made mistakes with the middle category in the last couple of years?
Oh, absolutely. I'd like to own up on one name, which we thought is actually borderline between the second and the third category, which is we thought it's under-discovered and it's only a 2-year track record, but we think we know and we understand the business. And this is a company called Camlin Life Sciences, or Fine Sciences, sorry.
Camlin Fine Chemicals.
Yeah, Camlin Fine Chemicals. And so we own another stock also in specialty chem, and we thought it's on that kind of track. Okay. They basically are a food antioxidants company, and they weren't even sort of so badly broken or challenged. They had to execute on what they had in front of them. And our sense is that the execution has suffered. The numbers have actually not come through, giving them a time of nearly the entire fund period that we owned it from, sort of, July, August of 2015. It's getting to, 2 years.
What typically was their mistake? I mean, was the original story called wrong, or have they slipped up along the way?
Okay, so multiple things have happened. Okay. I would say, let's say to start with, in an oversimplified way, they've, let's say we are expecting, say, revenue growth to come through, margins to be intact, and thus profit to come through. Capital productivity being similar as in the past. So no massive change in working capital or fixed asset is the kind of premise on long-term compounders. So I would say in the case of Camlin, all of these 3 or 4 levers have actually not delivered or have gone wrong.